Very good evening to all our friends, clients, supporters of ETFSA. This is our wealth briefing, mid-year 2026. The last time we spoke to you as a team was in January this year, so I think it's time to update you on our current thinking. I'm joined tonight by Susan Ramachabi, I think you all know her from the retirement funds, and Gareth Stobie, my fellow director. We will, all three of us will take you through our what we have to say, and we'll leave some time for questions. So please, at the end, if you've got any questions, put it through on the panel that's on the screen, and we'll answer them at the end of this presentation. So let's progress. Let's talk about the markets first, and the economies. Somewhat nice and coincidental, the IMF, which does twice a year, does its World Economic Outlook report, brought out its most recent report 2 weeks ago. So this is right off the press. And they call it the global economy and the cross currents of war and technology. And the interesting thing is, I think a lot of people are saying, well, what's going on in the Gulf and elsewhere? Surely the world economy is falling flat on its face. Well, if you look at the numbers there, the projections for 2026, World Economic Outlook coming down from 3.5% last year to 3% this year, and recovering next year. And we show you the advanced economies, the strongest of the current global economies, the big economies, is the US, expected to grow by 2.3% this year, a little bit up on last year, and carrying through to 2027. And the emerging markets and developing economies, particularly in Asia, that's where the growth really is, 5.6% last year, dropping to 5% this year, mainly because of the impact of the oil price. China and India coming off a little bit on their growth rates, but still doing very well. So what we're really looking at is the world's economy is still going along quite happily. There has been some disruption, but not massive. And as the IMF says on the left-hand side, or probably your right-hand side, war shock, that's impacting on energy importers, people who have to import energy because of oil prices going up and some other prices going up on energy. But most people are coping. There doesn't seem to be a shortage of oil. If you can't get oil out of Iran or through the Strait of Hormuz, there's alternatives. And so that's being coped with, but with an impact on prices. What's really driving global economies is AI, our artificial intelligence, which the demand for that is really lifting countries that are integrating the global technology value chain. And that's not just the Americans. The big and really hot area for AI development is in Asia. There was some concern that inflation, inflation was coming down steadily, and that might create disinflation, which of course is prices coming down, not creating incentive for growth. But that disinflation is stalled. There now is inflation back, but the inflation impact is relatively muted. So I think and this is the hundreds of economists that the IMF employs to do the economic outlook, how they all come to agreement is something that I think is quite difficult to understand. You know what they say with economists: if they took all the economists in the world and they laid them down, head to toe, they'd stretch quite a long way, but they still wouldn't reach a conclusion. Well, that's the IMF coming to some conclusions here. So the big issue that has been hit is inflation. In America, we've had pickup from around 2.5% in January and February this year, rose to 4.2% in May, and it's since come off a little bit to 3.5%. So that inflation impact has really been all about energy prices, and America hasn't been able to escape that. Even though they produce most of their own energy, they are impacted by global prices. But the good news is that it's fallen off in the last month, and as you can see, core inflation has dropped. Energy inflation, 23%, now down to 15%. Food inflation hasn't been impacted. Services inflation. A lot of people say AI is expensive, and creating the energy to drive AI will push up prices, and services inflation will be impacted, or energy inflation. Not yet, doesn't look like it. And the month-on-month inflation rate in June actually dropped, 0.4%. So maybe we're at the end of this particular shock on inflation. If we go back to after the Liberation Day of Trump, last year, or the Russian invasion of Ukraine back in 2022, we saw inflation jumping to 9% in 2022, US inflation and global inflation, and last year to well above 5%. So this inflation impact is around. It's quite muted, and I think it's being accepted and absorbed by the markets. We'll hear, it's always one of these things, you do presentations, the Federal Reserve Governor is talking this evening on what they're going to do with the Federal Reserve interest rates in America. Just when we finish this presentation, he'll give us his decision. Most people don't think interest rates are going to rise in America, but there's still a possibility. But with inflation coming off a bit, I don't think they will push up interest rates, but they might well keep interest rates where they are for some time to come. So the risks of higher interest rates, which I think impacted on markets for a while earlier this year, does seem to dissipate it to some extent, and that's something we will keep an eye on going forward. Is it only the US? Well, UK inflation rates dropping quite nicely, as we can see. It kicked up to 3.3%, but since it's fallen off a bit, now 2.6%, the last number, and the month-on-month inflation rate in the UK didn't rise at all. So this inflation impact might be out of the way. Now, we can't say for sure because we don't quite know where oil prices are going. I mean, they could still spurt again, but it looks as though everybody's adapted to finding other sources of oil, and somehow or other these tankers are getting through, if not through the Strait of Hormuz, then through other routes, or oil has been transported through pipelines, or in fact people are just sourcing oil from alternative sources. Inflation, not as big a problem as we thought it might be. So let's go to what's really driving markets and even the global economy. And this graph shows US corporate profits. So these are the companies that are listed on the American stock exchanges, the S&P 500, the top 500 companies in America. And what sort of profits do they generate? Well, those figures there, 3.61, 3.62, are 3.62 trillion US dollars. And now, to put that in context, the South African economy as a whole is about 450 trillion US dollars. So just the profits generated by the private sector, the corporate sector, the big companies in America, are something like 5 times more, 6 times the size of the South African economy. And that's just in one quarter. If you add those profits up over a period of time, over a year or so, you'll see that the earnings that are being generated by American companies, and those earnings are what is driving the stock market forward, are significant, really big. And what's interesting is that just that private sector corporate profits contributes 12 to 14% of total US GDP. It is a structural shift. It's gone upwards from the 1990s when corporate profits were less than 10% of US GDP. But there's no other economy in the world, including South Africa, where your private sector growth in earnings and profits is driving the economy to the extent that's happening in America. And that's an incredible achievement in many ways on the fact that you have a private sector-driven US economy. Just to talk about it a little bit more, expected earnings growth of the S&P 500 companies is anticipated to be 26.5% up on the same period in 2025. Now we're about a quarter of the way through reporting on earnings growth in American companies for the second quarter. So still some's got to come. In fact, most recent numbers indicate that the earnings growth could be quite a lot higher than that 26.5%. But we're going from a fairly small sample. At the moment, we only know what the earnings growth has been for about one quarter of the US market. If you take then those earnings and you put them against the prices of the securities in America, the so-called price earnings ratio, at the moment it's sitting at just over 20 times. The average PE ratio for the past 5 years has been that amount. So people say, well, the American stock market is getting expensive. It isn't, because the earnings growth is growing at a faster rate than the prices of shares. So whilst it's not getting cheaper, it's also not getting more expensive. And so that's an interesting element that we've got to take into account. So if we're going to monitor anything driving the global economy. It's going to be how well do US corporate profits do. Now, many people say, well, it's all driven by the Magnificent Seven, and the Magnificent Seven's earning growth for the second quarter of 2026 could be 30% or so, because those companies are really pumping money. They're also spending money. Just the three biggest AI companies, Microsoft, what's the other one, NVIDIA, and not Alphabet. Anyway, the three biggest ones, they're going to spend something like $700 billion this year just on developing energy sources to keep themselves supplied with energy, because AI consumes a lot of energy. But that, of course, is $700 billion being pushed into the US economy. What's also happening is that if you forget about the Magnificent Seven, the top 7 companies in America in terms of size, and you look at the S&P 493, in other words, that's the other companies, they're expected to have the best quarterly profit growth since fourth quarter of 2021. 2021 was when you had full recovery from COVID and the US economy was really starting to motor ahead. It took them about a year or more to recover from COVID. So you've got this big profit growth taking place in the US, not really matched anywhere else in the world, because earnings are growing, but not at the same extent. And that's really the locomotive. If you look at what's the jet fuel that's propelling the global economy, enabling the IMF economic outlook to say, well, we don't see significant disruptions to the global economy coming from what's happened so far this year. It's really US corporate profits growth. So how have stock markets done over this last period? And here we're going back to the beginning of 2026. And those squiggly lines there, the yellow one at the top is emerging markets. So if you go back to the IMF economic outlook, you see that emerging markets are growing at quite a lot stronger growth rate than the developed economies. And that's reflected in emerging market stock markets. And that's really about 80% of emerging markets is the Asian stock markets, but you also have places like South Africa, Russia, Brazil, and elsewhere, the so-called emerging markets. But if you look at the others, they're all up so far this year. So here we've got this big disruption, what's happening in the Persian Gulf and all this uncertainty and so on. But we've still got a rising trend in other markets. S&P 500, the red line, the green line is the all-country world index, which is a global index. We've got the FTSE UK, and we've got Europe, the light blue line. So the only economy which hasn't done all that well, it's had negative growth over this period, this first 6 months first 7 months of this year, is South Africa. And of course, last year, South Africa was the stock market that was outperforming in dollars and in rands just about every other market in the world. So stock markets are actually saying things are okay. If you say, well, how's things done since the Persian Gulf War started, and so now we're going back to March this year, well, you see, yes, there's still been some quite good recovery. And the best performing market, not unreasonably, is the US, because it's got this big profit growth. And of course, the US is not really affected by what's happening in the Gulf, though. They're self-sufficient. Followed by the world index and then emerging markets, which is still giving you positive growth. You're getting lower growth, but at least positive out of Europe and the UK. And poor old South Africa is still lagging behind. So the markets have actually reacted quite well to what's going on. So if people say to me, well, surely there must be a collapse in global markets and in terms of all this uncertainty that's happening, that hasn't happened. If it hasn't happened up until now, it may never happen. So we have to keep that in mind. Typically, when things become disruptive, as we've seen in the last 6 months or so, you'd expect the people to rush into bonds. Bonds, of course, pay fixed interest rates, and therefore they're relatively safe investments. And we can see that in March, your global bonds kicked up quite a bit and gave quite nice positive returns. But since March, in fact, the interest rates have come down. The US 10-year bond rate at the moment is 4.6%, and the 30-year bond rate is below 5%. So they're not really giving you a great deal of protection against inflation and against uncertainty. And they've actually given you negative returns since COVID. The black line, which is US bonds, and the blue line, which is global bonds, have not given you positive returns. So the safe haven, which is to go into bonds when things get bad, the world is saying, or world stock markets is saying, stay in equities. That's where the growth is happening. The earnings growth is happening in equities. So can we come up with a global investment strategy? This is just our direction we would give, is to say that global equities are providing positive investment returns despite all this turbulence. Big thing is, don't underweight America. Big mistake a lot of people make. They say, well, America, surely it's got to go to recession one of these days. It's been growing since 2008. But the US stock markets constitute 65% of the weighting in global indices, MSCI World or the ACWI index. If you don't have exposure to America, you're going to underperform global equity markets. So you might want to go a little bit less than that, but don't go too low in terms of your weighting to the American markets. You can see it in the results of quite a few, even of our local asset managers who've under-invested in the American market, and it's really affecting their performance, and it's going to be very difficult for them to catch up. Emerging markets, good place to be at the moment, particularly the high-tech economies. And we're seeing just about every second day there's a new high-tech AI company lists on one of the Asian stock markets, whether it's Shanghai or South Korea or Taiwan or Hong Kong. We had CMXT last week, biggest Chinese or new Chinese AI company listing in Shanghai. They listed their shares at what seemed to be a reasonable price, and they went up 400% in the first day. They've come back a bit since then, but there's really a big demand for what these Asian economies can contribute to the growth in AI on a global basis. The conference they had in San Francisco last weekend, the Global AI Conference, all the headlines were about American companies, the Magnificent Seven and others, signing big contracts with Korean, Taiwanese and other countries to companies to import semiconductors, chips and so on from them. The Americans don't want to be solely reliant on their own production. So emerging markets looks good. High tech, I think staying with AI, semiconductors, chip manufacture and all the rest should still be part of your global equity exposure. The ones we like the most are NASDAQ, because at least there you're getting not only AI companies, but you're getting other innovative companies. And NASDAQ doesn't overweight. If you take a company like NVIDIA, it's 24% of the S&P IT index, but it's only 7% of NASDAQ. And all the other companies are then taking up proportionate types of shares. Or buy the EM Asia ETF. So you buy an ETF that just gives you exposure to emerging market Asia, and that's been a very good performer in the past over the past year or so. So global bonds not giving us the defensive hedge protection we would normally expect when market volatility occurs. So that's not your hedge at the moment. So we would expect, and that's what we do in our portfolios, is to keep to short duration bonds and income funds when we look at global bonds. What about commodities? I'll talk a little bit more about this when we get to South Africa, but there could be some opportunities when the Gulf crisis is over and markets go back to more normal in terms of resources. At the moment, resources have been quite badly hit by the Gulf crisis. So that's your global strategy. So let's now look at South Africa. The South African real GDP growth rate, that graph looks great. I mean, you've got all this positive growth happening, but then look at the numbers. This is quarter-on-quarter growth, 0.4, 0.1, 0.3, 0.5% first quarter growth on fourth quarter last year. That comes out at about just below 1.9% on an annualized basis. So that's why some economists are saying, well, South African economy might be able to grow by 2% this year, but I think the impact of the higher energy prices will probably pull us back a bit. But so the good news is we've had 6 quarters of consecutive growth. The bad news is that it's pretty small. It's pretty meaningless. And if you analyze deep down what's happening to retail sales in South Africa and other sectors of the economy, the only real area that's growing, as the governor of the Reserve Bank said last week, did his interest rate decision, is his net exports. Our export sector is growing. And in May, funny enough, we had a bad month, first negative trade deficit, first time in 18 months, but it's coming back. The June figures will be positive. So the South African economy is not giving us a lot of growth. Remember I showed you that graph? our market probably being the worst performing markets amongst the others. A little bit of background. 0.5% growth seems low, but our average growth rate since democracy, in fact, has been less than 0.6% per annum. One of the poorest performing economies in the world. Yet our stock market's done quite well, which shows that companies can do well no matter what's happening in terms of governance. The American companies are booming despite President Trump, so they can typically handle a lot of these turbulence areas by just sticking to what they are and the expertise they have, and of course the private sector's ability to generate profits out of just about any sort of situation. Future growth in South Africa is very dependent on economic reform, as we all know. So we're looking at the South African economic outlook. Well, weak economic growth I think will continue for this year, but we won't have a recession. We've had 6 quarters of positive growth, and it doesn't look as though we'll go back into a recession, which is 2 quarters or more of negative growth. Inflation will probably only start falling from late 2026. So I don't think interest rates are likely to drop this year. Economic restructure is critical in South Africa's economic progress. And every day, if you look in the newspapers, you'll see that somewhere the private sector's taken over doing what the government used to do. And that's generating some activity. Private sector is now providing more and more service of public sector. The big area to look at going forward is going to be transport. Transnet granting licenses for port operations. They already have Durban operated by a private ports company, and they've just issued tenders for Cape Town. Rail infrastructure concessions. The railway lines will be run more and more by the private sector, and the operating trains along the railway network, they've handed out these 11 contracts to private sector to run their trains down the railway network. So that's going to be the big area probably of growth and improvement going forward. So our economic growth will be very dependent, I think, on this movement. We don't want to call it privatization, but this movement towards being more efficient and providing services. How do bonds look relative to equities in South Africa? Because the equity market hasn't done all that well. Well, this is quite an interesting graph. What this says is the red line is the cumulative return since January 2024. So it's the last, 2.5 years from investing in government bonds, government ETFs, the Govi ETF. The green line is investing in an income fund that doesn't have the same long-term duration, 8.5 years exposure to long-term paper that a government bond would have. This is closer to 3 years, but they're performing almost at the same rate. And that number over that period of time, January 24 to June 26, is a cumulative growth rate of nearly 40% that you would have got by investing in government bonds, because they're not only they're paying you a high interest rate, but as interest rates come down, the price of the bonds goes up. So you've had a total return of 40% over that 2-year period, and that's as good as the equity markets have done. If you start going to shorter duration paper, the yellow line at the bottom is a 1-year income fund. They've also done quite well, but quite a lot worse than the longer term area. So if you're looking for something defensive in South Africa, I still think interest rates in South Africa are quite high. There's still a propensity to generate profits out of interest rates. As interest rates come down, you make profits on fixed interest paper, and you can trade in and out of different duration, flexible and fixed interest bonds. And the very interesting thing is that more recently, you're finding that you can get a better yield. In other words, this is just the effective yield without the capital profit of trading your portfolios in short-term bonds, the PMX Inc., which is a 3-year income fund, and the PIP ETF, which is a 1-year income fund, then you can get on government bonds. So if you say, well, I can go buy a South African retail bond and get an 8.5% interest rate, well, you can go buy an income fund and get a 10% interest rate. So your risk profile is changing quite a bit in South Africa as we have to finance future growth. The private sector having to pick up most of this up. You're starting to see very interesting opportunities opening up in the income markets. So we like income, we like bonds. Sector rotation in South Africa, how do the different sectors perform? Well, the C-Top 50 is the broad index in South Africa, the mid-cap index. Then we've got resources, we've got industrials, financials, listed property. The red line is how they've done for the year to date. And the green and the yellow lines is 5-year, 1 year and 3 years returns. They're very positive. So often the way to invest in South Africa is, particularly through ETFs, is to say, well, I can buy an overall top 40 or top 50 index, but if I sector rotate, maybe buy resources and industrials or financials and listed property at the right times, I get a better return. And there I'm also showing you the defensive assets, the returns you've got out of income funds and bonds. So South Africa is still giving good returns. It's abated a bit this year, but looking forward, the market has underperformed global equities since the Persian Gulf crisis commenced, but it currently offers good value. The current PE ratio in South Africa is about 9 times earnings, compared with 20 times in America. So our market's about half. In terms of value, it's offers much more value in America. The implied earnings growth in South Africa is about 11.5% per annum, which is of course lower than the US, but that's still reasonably good earnings growth. So the equity market, I think, still offers value. It will recover at some stage. Sector rotation, buy broad all-share ETFs, resources we like, financials we like. I think the resources companies, Valterra reported this morning on their results, which is a platinum company, and their earnings went up 93%, and their dividend went from 2 rands a share first half of last year to 57 rands a share. So it was something like a 3,000 rand improvement in earnings. That's just because of the higher prices of platinum group metals and other resources. Financials are also going to report very good results. Listed property companies are consolidating, they're sorting themselves out. So I think there's still a place to make money in equities. Interest rates only likely to fall late in 2026, 2027. So I think that's still a place that you can look for a defensive positioning. We favor income ETFs over bond ETFs, as I tried to explain with that slide that we showed you just a few slides back. Cash and money market rates, they're too low. If inflation is sitting in in South Africa, and I didn't put that inflation graph in, but our inflation rate's about 5%, and you're only earning 6% or less in a money market rate or deposit at bank, that doesn't give you any protection against inflation. So we do favor income ETFs. And we think there's some value still in South African equities, but there's quite a bit of faith. We have to continue to see this movement towards economic reform. So I think that's given you a bit of a background, and I've taken up my full quota of time. So let's move over to Susan. So you've got somebody much better to look at than me. And thank you, Susan.
Thank you very much, Mike. That was very informative. I'll just take you guys through the changes since we last had our seminar in the retirement industry, together with our relaunch of the Preservation Fund. So what has changed since our last seminar? As we may all be aware that we had a budget speech which informed us of a few changes which right now, being a person working in the retirement industry is totally happy to see increases like this, because they motivate retirement savings and keep investors interested in saving for their retirement and also saving on their tax. So one of the changes was the contribution limits that have increased from 350,000 to 430. That's a nice increase, but also remembering that the cap still stays at 27.5%. So if you are one of those investors with high income, your cap is 430, but if your income ranges below, it's still the lesser of the two, which would be your 27.5%. Together with that, they've also given retirees an advantage of accessing lump sums at a higher withdrawal rate. So before the budget speech, the withdrawal lump sum limit was about 247,500, and it's now increased to 360,000. And if you're retiring from any retirement product and you haven't used your 550, you would actually receive this as zero tax. So it will be literally a lump sum into your bank account. So it gives you that advantage of actually waiting till you retire to access this, and also giving you the flexibility to save for longer, to actually not withdraw before. So reaching the 360,000. What hasn't changed? So the retirement tax tables remain the same. You still have your 550 at retirement that will be tax-free. And if you're doing a withdrawal before retirement, the 27,500 is tax-free. Obviously, only the first 27,500, but the next withdrawal that you do, being that we have the two-pot system, we have other withdrawals that you can do from your withdrawing from your retirement products, you would be taxed. And then together with that, it's always interesting to see the impact of what the two-pot system has done for the retirement industry, especially because retirement products have always been seen as a restrictive investment product. And after the two-pot system in September 2024, it's changed the playing field, because now a retirement annuity is no longer seen as a product that you can only access at retirement. It gives you allowance to now do one withdrawal per tax year, but also remembering that once you've done a withdrawal, you need to keep saving so that your 1/3 goes into the savings component so that you are able to actually access another withdrawal. So this also gives you an advantage of continuing to save while also remembering that with this, should you stumble, you can actually access something from your RA. What hasn't changed? The importance of saving hasn't changed. Retirement savings have always been something that people try to overlook, but the impact is so tedious, because half the time Mike and Gareth will always tell you, with the experience of clients get into retirement, and it's always a struggle looking at trying to plan and strategize for somebody who sort of halfway remembered, let me start saving, and now it becomes pressure. So it's very important to start as soon as you can, because statistics show that we're living longer than expected. And also there's no certainty of how long you're going to be working, how long you're going to be employable. So it's vital to start as soon as you can, and also maintain that, remembering that starting to save for retirement doesn't need you to wait till you get that big lump sum or get a certain salary income for you to start. You can start with as little as 300 a month and grow from there, because the earlier you start, the more you give your money time to compound for you. As you could see on that graph there on your right hand side, my right hand side, your left, the earlier you start, you'll see as that curve shows, the red curve, the 25-year-olds started as soon as they can, and there the curve allows the compounding effect, which is what we encourage investors to do. Not wait, but start as soon as you can. And then with that, ETFSA offers you 6 investment portfolios that you can invest in, and they range from low risk to high risk, mainly focus on the time to retirement that you have, with the effect mainly focusing on how much composition of your defensive assets you have compared to your growth assets. And you'll see the green section of these of the graph, that the more riskier the portfolio is, the more the growth assets are. So with a high portfolio being our Wealth Velocity, relatively new portfolio, but certainly doing a lot in the investment industry, currently performing very well. And then we have our Wealth Enhancer, which is our also high risk portfolio, high equity. And then the Wealth Default, which is our medium to high risk portfolio. Then the Wealth Builder is our medium risk portfolio with about 60% defensive, and Wealth Conservator, which for this one, it's mostly for people who are closely approaching retirement, wanting to preserve your capital, and you have about 40% into your growth assets. While Protector is fully money market, so it's fully defensive. Next, we go into how it's performed, how our portfolios have performed over this till 30 June 2026. So you'll see that all our investment portfolios have actually outperformed the ASISA sector average. For example, our Wealth Velocity, which is fairly new, but the performance has been amazing. It's actually performed way more than what your ASISA average gave till the 30th of June. And that going into our Wealth Enhancer, which has also outperformed the ASISA sector average through the 1 year, the 3 year, and the 5 year period. Then our Wealth Default also performing relatively well, not forgetting that it's a medium to high risk portfolio, but it's also outperformed the ASISA sector average with a good difference. which is why it's also an encouragement to those investors who say, but investment portfolios in retirement products are Regulation 28 compliant. I want to choose what I want to invest in. Here are good portfolios that are outperforming ASISA sector averages that you can invest in and actually get good return for the time that you invested. And then together with that, we have relaunched our preservation fund, I think a month ago. And the reason for this is that we have seen how preservation funds have been overlooked as a retirement product, mainly because most investors leave employers and they leave those pension funds or provident fund with the employer, which indirectly deprives them of the flexibility and the most of all the power to make a decision on what you want to do with your retirement product or your preservation or pension fund. Because while it's within the employer, the trustees or the board of the umbrella fund or the pension fund make the decision for you, while you deciding to move your pension fund or your provident fund to a preservation fund, you're allowing yourself the choice to consolidate your investments, put them into one product that can perform, like I've shown you in the previous slide, give you good performance while also making sure that the fee is at a rate that is not eating within your capital. So we as ETFSA are offering you an opportunity to help you through the process of consolidation, and this would not only do this process, but we make sure that you still retain your once-off withdrawal that you have within the pension fund act, where a preservation fund still retains that once-off withdrawal you have. So moving from a pension fund to a preservation fund, we do that for you. We assist you through the process. And most of all, we give you the choice or even advise you on how to invest it based on your investment goals, but also based on your time to retirement. So this is certainly an opportunity for mostly, I'd like to say people my age, but I think it's a situation throughout investors who have pension funds all over with previous employers, where we here, contact us anytime. We can help you consolidate and help you put it in a product that's tax efficient, that can give you good growth, and most of all, grow your funds. And from here, I won't take too much time. I'll pass on to Gareth, who will share more on ETFs and the offshore assets.
Great, thanks, Susan and Mike. I've been asked just to update our clients on what's going on in the global ETF space. Now, just about all of our investors do have access to global markets through ETFs. It's one of the great appeals of ETFs as a product structure. But I thought I'd look at it through a few different lenses tonight, because particularly because earlier this year, in April, ETFSA actually launched its own new ETF in partnership with Prescient that is a 100% global ETF. And I think it was cause just to pause and explain to clients the different avenues that are available to offshore markets and offshore indices. So as we know, one of the big benefits of ETFs is this immediate access to big global stock markets, starting with the S&P 500 being the flagship kind of product globally, and these days probably in South Africa too, driving this ability to buy one security and to be immediately invested across the US market like that is obviously wonderful, and you have similar sort of access to the FTSE market, to the NASDAQ and other global markets like Hong Kong and so forth. From there, from that original base thesis of ETFs, the world has exploded in terms of the number of ETFs that are available now to capture various sectors in the market, asset classes. Mike spent some time on the fixed income markets tonight. Increasingly thematic products, and these can be from hyper niche products. I mean, the other day in the office, we were just looking at an oil tanker ETF that was available that obviously shot the lights out during the Iranian conflict, through to commodity ETFs, which we know well in South Africa, like gold, platinum, and so forth. So really the world in many respects is shifting away from single stock selection to building up portfolios using ETFs, which you can do very efficiently across just about any investment thesis. I think the wonderful thing is that the work to pick a particular share has been taken out of your hands. You can just, simply buy the ETF and be immediately diversified. I say our clients have just about all got exposure. I'm pretty confident they do, and that's either through rand-based products. Take, for instance, the 10x S&P 500 product, which is something I was involved in launching, where you buy it in rands on the JSE and it gives you immediate exposure to the S&P 500. And then we have a number of clients who have actually externalized their monies, and where we are managing those monies in a hard currency stockbroking account in their name. Naturally, that has a different set of circumstances to it. You've used your offshore allowance to move the funds there, and the reporting that we give is both rand-based reporting, what those returns translate back to in rands, or indeed in the hard currency. So really, that we are completely spoilt for choice, and ETFs have really opened that all up. And as I say, there really are the three options available to you. There are the various feeder funds available on the JSE. There's several dozen of those now available. Mike can give the exact number, spanning most of the global major global indices. However, not too many options available just below the major indices. So we haven't seen too many specific sector products come out yet. The thematic options available are still fairly limited in some respects, and I guess that's about scale for the local issuers, because if they're going to have a slightly more niche product as they translate that money into offshore markets, they need to make sure that those individual products stack up and make sense from their standpoint. So that's the first option. I would say as a business, we are mostly invested in option number one, where we're holding rand-based products tracking global indices, either in discretionary accounts or our RA portfolios that we run, very much so on our Investor Hub portfolio. Then, very exciting, earlier this year in April, we put together basically our own flagship global strategy. So the goal here with the Oyster portfolio, which we launched in April, is to take the hassle factor out of clients' hands. Instead of trying to build your own portfolio and work out how much S&P 500 to have, how much FTSE to have, for instance, this portfolio basically does that all for you. It's already mixed portfolio where we are guiding the strategic architecture and the selection of both ETFs that we have in that portfolio and different notes and other instruments to build up the total strategy. This also trades in rands and is available on the JSE. We have been running this portfolio for quite some time for our living annuity clients, and we're using it sporadically in some of our managed accounts, but is also available on the Hub platform too. And then lastly, the offshore holdings, where we have opened hard currency accounts for clients. We typically deal in the three major currencies, euros, pound sterling, and US dollars, and we can manage those accounts. And very often, people have got monies from previous employment they might have had overseas, monies that they've inherited, monies that they've deliberately taken offshore, or from a property they've sold offshore. There's a whole bunch of different reasons as to why they may have those dollars there in the first place. And as Mike says, to hold money in offshore cash really doesn't make a lot of sense. It's best to put that money to work. So, those are the various structures that are now all available in ETF form. And very often when you're moving that money offshore, buying these different ETFs, these are the big major issuers that you have exposure to, and you're leveraging the amazing depth that these companies have. So across iShares, Vanguard, and State Street, now over 11 trillion under management, shows you how successful this product wrap has been. And that sort of scale has driven amazing price efficiencies for clients. So most of the ETFs that we buy offshore have got TERs of under 10 basis points, which is obviously tremendous in terms of the long-term compounding of that cost saving. They very often have a strategy listed in multiple currencies, so you can buy the FTSE not just in pounds, but you can buy it in dollars or euros and that sort of thing. And we can hold that strategy in a number of different jurisdictions. I'm going to touch next why that's so important. So the same strategy you can very often buy in the US or an Irish domiciled fund or a Luxembourg domiciled fund, or you can buy potentially a strategy in other markets as well. This is a bit more on the Oyster Fund. So this slide shuffled differently to what I expected. Just a summary on the Oyster and how it's currently invested. As I say, we launched this in April. We now have just under 350 million invested in it. Strategic asset allocation to be growth orientated. So the bulk of the portfolio is obviously invested in equity with a small allocation to fixed income and commodities, and a couple of tilts to particular themes that we like. We touched on AI earlier. We do have an AI infrastructure exposure here, which has caught a lot of attention, where you're investing in the full supply chain of AI. So not just the NVIDIAs of this world, but the chip manufacturers, the energy producers, the warehousing and specialist REITs that support an investment thesis like that, as well as other themes like US mid-cap, where we expect some of the US growth to filter down into the rest of the economy. So yeah, it's a very well diversified portfolio, strategically set, and the idea that you can buy such a comprehensive portfolio like this by simply buying one security obviously is tremendous, and you'll see a lot of information around this on our website. And simply called the Oyster. Even the share code is Oyster, which worked out nicely. It's 6 digits, six letters. So yeah, shout if you want to have more information on that. And then just to wrap things up so that we have time for some questions. Sorry, a bit of a busy slide, but we have had a lot of clients ask us around what is the tax implications of having money in offshore ETFs and investing globally. Now, naturally, if you have money invested in rand-based products, you don't have to worry about any offshore tax authorities. That doesn't affect your life at all. Your estate will be wound up just here in rands. But we do have clients, sometimes much larger clients, who have got money that is building up for some time offshore, often much larger sums of money. And here the issue of US CITES tax. CITES is a fancy Latin term for situated. Where is your asset situated? So it's US CITES tax and UK CITES tax comes into effect. And here basically, if you have assets in those markets over a certain threshold, so in the US it's $60,000, which is actually quite low, and the UK £325,000, there's additional state taxes that may be levied on your savings abroad. Now that's the worry, that's the concern that's often brought to us because clients are made aware of that. However, the major solve that we use in our business is to buy funds that aren't domiciled in those regions. So we very simply buy ETFs that are either domiciled in Ireland or in Luxembourg, where basically the CITES tax doesn't apply. Yet you're still getting the underlying exposure, which might be US or Europe or what have you. Furthermore, the Irish funds have got a very favorable double taxation agreement, particularly with the US. So even the distributions that are coming, say, from the S&P 500 stocks, you don't pay as much dividends withholdings tax on that. We have also had questions from clients from time to time about endowment wrappers that are out there in the market. Often a lot of scaremongering around the CITES tax. So, a lot of life houses and that offer these endowment wrappers. They're not, the downside really with them is that you're locking your capital in for 5 years and they are more expensive. It's not impossible to run an ETF portfolio in these. So if you want to chat to us about that, it is another option. But really, the problem, by and large, is solved through the use of the particularly the domiciled products out of Ireland. So I just wanted to touch on those aspects. And now we can open it to questions. And I'm going to, because I only had 4 or 5 slides and not very much work to do, I'm going to chair that. And I've got this little keypad here, and I'm just going to run through some questions. So catch my breath. So the first question, I should have said this throughout, the presentation will be recorded. You'll see that we're running an events tab on our website that features up-and-coming events, and all of our past events there are saved, and you'll see recordings of those. We're also loading them up onto our YouTube channel. And any questions that we don't deal with tonight, we will come back to you on email as well. So don't stress if I don't read out your particular question. Mike, a question for you around from Clive around the so-called AI bubble, concentrated providers in that space. The different AI companies, big IPOs coming to market. I suppose he's citing things like SpaceX. Then there's the conflict in Ukraine and Middle East. Major political shifts, I suppose. There's all the right-wing or conservative movements, shall we say, likening it to World War I. So I suppose a much more concerning outlook coming from him than perhaps you painted. What would you say to Clive around all of that?
Well, Clive's an old mate of mine, and he's always he's always worried about something. But in the end, the markets tell you where things are going. And if you've got all these circumstances, but the exchange markets, currencies, equity markets, bond markets are not pointing to collapse, and that's what you're going to go by. So if your view says that this is World War I and all the rest, now that's, I don't want to call it an extreme view, but that's an outside view. That's not the view that everybody else has. And so you've got perhaps some reason to be concerned, but what I typically would say to people like Clive, and hello Clive, by the way, is make sure that a big chunk of your money is managed by asset managers that are professional, that understand the markets and realize what's going on in the bigger global markets. And if you want to exercise your concerns yourself, probably only do that in a relatively small portion of your portfolio where you can go into more defensive type of strategies if you think that's the right thing to do. So, what I spoke about, and I think Gareth as well, is that the markets are the collective wisdom of all the investors everywhere in the world, and that collective wisdom says things aren't too bad. And that's really where we are. We're at the status quo. Anything else is, well, these are concerns, but they're on the fringe.
Yeah. Okay. I once had someone once, we were talking about AI and whether you can use AI to invest, and his remark back to me, which struck a chord, is markets are in a sense a form of AI, to your point, a collective wisdom. There's a lot of market participation in the same way as a large language model will spit out an answer. In a funny sort of way, the market spits out an answer based on millions of inputs from both professional and retail investors alike. It's not to say, of course, markets can't sell off from time to time, which is why we obviously guide clients on the asset allocation, making sure that the term that they're putting in their mandate with us is the term that they're prepared to ride out. So even if we do have a pullback in markets, their long-term goals from a growth asset allocation perspective can be met. Susan, a couple of questions from you. Interesting one in terms of if a person's working outside the country, would it benefit them opening up an RA, and do they need to open up multiple RAs?
Okay, so that really is determinant on the plan. So if you're working overseas, but you have the intention of coming back into South Africa, then yes, because you would be saving here, ensuring that ultimately with your retirement plan, you would retire in South Africa. Then in that way, you're saving to actually end up in a living annuity and getting income from a South African retirement product. You can have more than one RA. Nothing restricts you from having more than one RA. Also remembering that within those RAs that you have, 3, 2, 5, you are still contributing and controlling your limits within the 27.5%. But remembering also that even if you go over your limit, it is not a train smash. Any credit that you contribute into a retirement product gets carried forward to the following tax year. So you can contribute as much as you can or as much as you want, but it's not something where you get taxed for it or something happens to you for that.
Okay, great. Question here from Anthony over the structure of the income ETFs. He's obviously looking at your slides, Mike, when you were talking about the different yield products. Do they generate interest income and capital growth? I don't know if you want to take that.
Yes. The the interest yield on an income fund probably would be around 9.5–10% at the moment. That's purely the interest yield, and that's taxed effectively as interest income in your hands. The rest of it is capital growth, and that's where the manager of the income fund manages to create capital profits by buying bonds at a discount and selling when they get closer to par or to maturity, or pricing differences that take place in markets. And they're very skilled at doing that. And the income markets and the bond markets are much deeper and much bigger in South Africa and globally than the equity markets. Well, equity markets globally are bigger, but South Africa, the equity market's quite small. So income funds are really very interesting, and there's some really good specialists in South Africa that are producing good income markets. We research them quite closely. That PMX fund, Portfolio Metrics, that we use on our slides, that's a really good fund, but there's others. And it's interesting to see that quite a lot of other issuers are bringing out income funds in South Africa. 91, South Africa's biggest asset managers bought out some income funds, South Africa and global, and there's others happening as well. So income funds, a great place to be, and we can give you more detailed advice if you need it.
Yeah.
But it's something that's crept up on us a bit, because the JSE regulations only really recently changed to allow income funds to be actively managed. And income fund, you need to be able to move from one flexible to fixed interest paper and vice versa, and so on, take advantage of new assets that come onto the market. And so actively managed income funds have been the fastest growing sector of ETFs in South Africa. And that's something that's well worth looking at the opportunities that are there, particularly for people who want to take income out of their portfolios.
Yeah. Okay. A question from Eugene around, a couple of questions from Eugene. I'll try to get to them. His most recent one, the EAC of the Oyster Fund, and is it included in the RA Wealth Enhancer or the Velocity portfolios? So what we can't announce the official TR yet, Eugene, because the fund isn't a year old, but we're targeting between 0.5% and 60 basis points. So that includes both the fund that we're running here in rands and all of the administration and governance around that, as well as the underlying ETFs that we're buying offshore, or the various notes that give us those index exposures. It is not included in the Enhancer portfolio or the Velocity portfolio, although obviously some of our thinking from the Oyster portfolio carries through into our other work. It's not a Reg 28 product because it's 100% offshore. But if, for instance, we have a view on emerging markets for the Velocity portfolio, we would naturally carry that view through to the Oyster portfolio as well. So you also had a question on the local earnings growth and PE. I think we meant to say earnings yield there instead of earnings growth. All right, then what else have we got here?
No, it's earnings growth.
Was it earnings growth?
Earnings
Okay.
growth, yeah. So the earnings growth in South Africa is about less than half the earnings growth in America.
Okay.
But the earnings are still growing at a faster rate than prices.
Okay.
So the price-earnings ratio is falling, which makes the South African market quite attractive from a valuation point of view.
All right. Okay, let's see what else we've got here. Question from Nikki on the Oyster portfolio. What is the expected return on investment on the Oyster yearly? Should you invest $5,000? So I guess the first thing to say is that you wouldn't have to invest in dollars. You can simply invest here. And Nikki, I'll give you a very sort of boring academic answer to the return on investment, because obviously we can tell you what the backdated performance is, but on a forward-looking basis, this is mostly a growth portfolio, so it's going to be very heavily weighted towards global equities. The long-run average of global equity returns is around 8% in hard currency, real return, 8%. And then you've got to convert it back into rands, which will give you another carry in the sort of the rand dollar conversion. So you should comfortably receive over the long term, well over 10%, 12%, potentially much higher than that. And that's hopefully a conservative answer. But that would obviously be if you hold it over the life, over like a 5-year term. If you're going to hold it for 1 year, it could be that because it's a growth portfolio, we might have poor markets over that period of time. So you've got to appreciate that it is very much a growth portfolio. All right, let's see what else we've got here. A few more. How are we doing for time, everyone? Maybe
Just after 7, so
okay, so maybe take
few more minutes.
one or two more questions. Maybe Susan, for you, a question from Fumani. Can you please share some light on the cost of the ETFs and the platform? So maybe, I don't know if you want to work through our different, one or two of our offerings there.
So I'll start with the RA. So the retirement annuity is currently on an EAC of 1.11% per annum, including VAT. And it's important to remember that on the retirement annuity, this fee includes the trading and everything. So you won't find yourself having to want to know what the trading costs are on your RA. So your portfolio, whether you switch 100 times or you investing additional contributions, there won't be an additional charge over and above the 1.1%.
Okay, great. Okay, then we'll close off here. Let's see here. We had a question also from GM asking around the tax implications when I invest directly offshore. And hopefully I gave quite a lot of context to that with that last tax slide. All right, and then there are a handful of others, and I haven't even pressed the refresh button, and I think there are a whole bunch more still coming through. But I think let's leave it there. I think it was a lovely conversation, quite varied, from Mike's economic overview to what's going on in the retirement fund, and just some quick snapshot from my side. But as always, please feel free to email us, get in touch with the team. We do pride ourselves on our communication and our service standard. And on that front, the one thing that we would like our clients to really do when you find 2 minutes is to go on to whatever your preferred rating system is, whether it's Google reviews or Hello Peter, and tell the World Wide Web what you think of our brand, because we'd really appreciate that. And we'd love to get your response, and we'd love that feedback. So thank you, and thanks everyone for your time tonight. Thank you.
Thank you.
Thank you. Good night.